Well, big bank earnings are coming in fast and furious, with JP Morgan kicking things off this morning, beating on the top and bottom lines. Still, shares fell 4%. Tomorrow, we'll hear from Wells Fargo, Bank of America, and Citigroup before the bell. Joining us now is Piper Sandler Managing Director Scott Siefers. Scott, good to have you. Is there anything that you could pick up that investors were particularly reacting to in JP Morgan's quarter or its outlook, or was this kind of a standard sell the news response on a good number?
Good question, Mike, and thanks for having me. So I think for the most part, what we're looking at is a sort of a sell the news. If you look at the actual quarter, as you appropriately noted, it beat. The guidance was either the same or actually a little better, depending on how you look at the NII. So the quarter itself and the outlook, both really good. Having said that, a couple of messages I'd leave you with. First, the group, including JP Morgan in particular, has already done quite well coming into earnings season. So I think there's a sense of sell on the news. But, investors are also grappling with this new issue of President Trump's Truth Social post from Friday night proposing a cap on credit card fees. So I think there's some lingering sort of hangover from that as investors digest what that could mean should it come to fruition.
Yeah, I guess what would you kind of come down on in terms of what any likely outcome would be? This could just be a jawboning campaign and you can shame banks into trying to lower rates or something like that. Or maybe it just brings a renewed spotlight onto how high some credit card rates are, and even, I guess, the interchange fees, charged by Visa and MasterCard. Those stocks are weak. I know you don't cover those, but it's just interesting how you could actually see this non-specific threat start to get priced in somehow.
For sure. And I think you actually framed both those issues quite well. Just as I look at things, there's been a theme to President Trump's communication over the past week or two. He's definitely targeting affordability. So when you think about things like credit card rates or even interchange, I can see why he would go after those things. But to answer your specific question about sort of, likelihood of these things coming to fruition, at least on the credit card interest rate cap, I would say that feels like something that would be very, very tough to put into practice. Credit cards are unsecured loans, and that's why rates are generally pretty high. So I think this would be one of those kind of horrific unintended consequences if something like this happened. What you would really do is just really severely limit availability of credit, particularly to people who need it most, presumably. You would probably also have to just shift fees elsewhere, like annual fees would probably have to go up. And then all the rewards programs we've become accustomed to over the last several years, those probably get ratcheted back. So I can't really see how something like this, despite perhaps a very nice intention, would be a good thing at all in practice.
As we look ahead, what should we be keying off of when it comes to Bank of America, Wells Fargo, the other big diversified banks, and Citi as well, whether it's on the trading side, the investment banking side? Where's the bar?
Good question. I'm glad you pivoted it back to earnings, because the earnings we expect to see are actually going to be quite good. As we look, probably 4 or 5 things. Loan growth has sort of normalized, but I think you're going to see expectations that it will actually improve as the course of the year plays out, in part because of the big beautiful bill and the ramifications that are positive that should hit this year. The rate environment is very benign, so you should see net interest margins, which are a big component of bank revenues. Those are going to sort of grind higher over the course of the year. The fee outlook, which includes capital markets such as traditional investment banking and trading, that environment is very, very good. There are just really good backlogs, so this should be another good year there. Credit seems stable, and banks have a lot of excess capital to put to work, so that should be a good thing as well. And then finally, the direction of travel, even if it's not every day, the direction of travel in terms of the regulatory environment is very, very good. So the fundamentals themselves, I think this is shaping up to be a really positive setup, both in earnings and for the year beyond.